Good afternoon, everybody. On the third day of December. So I have not done one of these videos in a while, and I don't have a great excuse other than I did a ton of work in October leading up to the election. I did that webinar. I had an awful lot of client and prospective client Zooms and Skypes talking about the election. And then, as some of you, many of you, most of you know from my writing, I had a little bit of surgery in early November, right after the election. And while I'm fine, and I probably work more than I did before because, frankly, I'm laid up, so there's not a lot else I can do. I just haven't sat down and put my ugly face in front of the camera and done a video. So here we are. Hope you had a great Thanksgiving. It was certainly an unusual one, but nonetheless, I hope it was meaningful. And certainly let's hope next year is a return to complete and utter normalcy. I think we could all benefit from that. December has started, and usually I say this time of year, wow, the year just flew by. I can't believe another year. Meanwhile, this year feels like it's been a decade already. So I will be looking forward to turning the calendar and getting to 2021, like I'm sure most people are. So let's dive right in. I'm going to cover 4 topics today. I'm going to cover the election, the market's foundation, sentiment, and a little bit of seasonal comments. If you like what you see, please give me a thumbs up on YouTube, which my buddy Tiny always says. Make sure you ask him to give you a thumbs up if you like the video. I will try to pull up some charts. I'm not overly prepared like I normally am, but I will nonetheless try to pull up some charts to articulate my points better. So let's start with the election. Those of you who came to the election webinar, I think everyone got the link afterwards. I know it sold out pretty quickly and it got filled up. I think our own clients probably took 75% of the seats before I opened it up to the public. So, but I sent down the link, whoever signed up and just couldn't get on. So you should have seen, if you're interested, what I had to say about the election. It turns out our models were spot on again. That makes every election since 1992 that our election model accurately chose who the winner was going to be. I don't want to get into whether the election got stolen or there was fraud or anything else. I certainly, it's not the time or the place to comment on that. Just that, and our model is quantitative. It looks at 3 different time series in the market to choose who the winner is going to be. That's it. It doesn't have anything to do with feelings or here or anything else. It's just a quantitative model. It can be right, it can be wrong. It's been pretty accurate in the modern era since it was wrong in 92, and since then it's been right. I'm sure it'll be wrong again in the future because nothing is foolproof, and it was wrong in the past. So that was the election. The model hit the nail on the head. If you read the blog, if you listened to that webinar, you know my thesis was whatever decline we get into the election, stocks were going to bottom before the election. That was one of my highest conviction plays, trades in many, many years. I felt so certain that stocks were going to bottom before the election and then rally sharply. No, I didn't look at it magnitude wise and say, we're going to run and have a 10% November. I did not look at that because I'm frankly, I'm not so great with short-term magnitude. I'm pretty good with the short-term direction, but the short-term magnitude, I haven't found a useful tool in my arsenal that gives me magnitudal. Is that a word? Magnitudal. If that gives me, kind of a magnitudal edge at what we're looking at. But I felt strongly that we were going to rally because so many people were so worried about the election. They're worried if Trump wins again, if Biden wins, or you have a blue wave, is nobody going to win? Is Trump going to leave the White House peacefully? All this nonsense. And frankly, I put my blinders on. I don't care about the nonsense. I said, look at what the market is doing in the reaction, not what the news is. The market had no worries that there was going to be anything out of the ordinary. And that's why the market bottomed before the election and went vertical the day, 2 days before, and then after the election. And frankly, as I said on our election webinar, the market was thrilled that right now it looks like you're going to have a balance of power. It's going to be red and blue having to work together. Obviously, the Georgia runoffs could change that, but the market's not smelling that right now. So that's the election. I will say this, usually after a Democrat supersedes, what word am I looking at? Supersedes a Republican, the markets put some kind of peak in the following year and then have a roughly 18-month sideways movement, period of pause, bear market. However, Obama came in after W, and that was 09, and the market soared in 09. Well, that was also coming off the worst bear market since the Great Depression. And before that, Clinton took over from Bush 1, and 93 was a decent year. It was a quiet year, but nonetheless, it was a quietly positive year. 94 was not a good year for stocks. So what happened in years before that, I'm not sure how relevant it is now. And also, if there is split government, they're not going to do a whole hell of a lot in 2021. I feel strongly we're going to get some kind of stimulus, not the $3 trillion that was hoped for if there was a blue wave. So you can see the winners and the losers. Since the rally began, there has not been a lot of losers. That rising tide is lifting all boats. And I hear just this morning, someone talked about how high prices were in the stock market. That's nonsense. If you look at the stock market over the last month, it looks like it goes straight up, right? But if you look at it over the last, year, it hasn't made a ton of progress. So it really depends on what lens you're putting on. Don't get wrapped up in where the absolute price of some index is. Who cares? Depends on what lens you use. So that's where we are election-wise, leadership-wise. I wrote about this on the blog in August, and I had said that I thought this long-term period of outperformance by the what I've called the Fab 5 plus, the FANG stocks plus Microsoft and a bunch others that have gone, just vertical. I thought that saw a peak of significance in August, and that was the same time I put out that controversial piece about selling Apple, which got me probably more hate emails and comments than I've had in a long time. I don't hate Apple. I don't love Apple. I don't care. I just want to make some money. But because of what had happened with that small group of stocks relative to the rest of the market, the odds favored some kind of peak of significance and other leadership coming up. Well, since the market bottomed on October 30th, we have had brand new leadership, small caps, value. First time in over a decade that those groups have really percolated and taken off. There have been other fits and starts along the way. And I don't use the term this time is different, but I would say this, I think there was a seminal change. It doesn't matter that small caps may lead or lag next week, today, tomorrow. I think over a period of months, quarters, and perhaps years, that whole big trade has turned. Doesn't mean your Apples and Googles and Teslas, what have you, have to go down, but it does mean that I think leadership will either broaden or completely change over. So those over-owned stocks may not be the future winners. Take that for what it's worth, but I feel confident that we have seen a seminal change in market leadership. So let's spend a couple minutes on the foundation of the market. And with that, I am going to pull up a chart and talk about, maybe I'll give you one example from each side, if I can quickly pull it up. I'm trying not to use my blue filtering cheaters. I always feel like I look old, but I may have to. There we go. Okay, so let me share my screen. Good. It's a free chart in Stock Charts. Anyone can pull it up. Nothing special about it. Let's see. And what you'll see up here in the top chart is the S&P 500. Nothing special about that. It's just the index. And at the bottom, you'll see the NYSE advanced decline line. A canary in the coal mine I write an awful lot about. It's one of my favorite canaries. And that's because what you can see is since we bottomed on October 30th down here, the participation in the rally has gone absolutely vertical, straight up the right-hand side of the page. That is very healthy. Bear markets do not usually begin with the NYSE AD line making all-time highs. And that's a comment I've made for years and years and years. It's not perfect, because I'll tell you, in February, it was also making fresh highs, and then the market rolled down 30% plus. But what that told me at the time was, even though we rolled 30% lower, because that AD line made an all-time high last February, it means that the bull market was not done in this line going up. So after we bottomed it, a month later in March, we went on right back to all-time highs. That's where we are today. This insulates the market from a long-term bear market. We saw in February a very unusual peak, the COVID peak, and then the 30% plus decline in March. But this is very healthy, and it says you buy any and all weakness until proven otherwise. So the market's foundation is strong, very strong. And there's one other chart that, oh boy. When I label my stuff, I label it in my mind so I can easily find it. And then when I go to find it, I have a tough time. Let me see, this is it. Is this it? Yeah, kind of, sort of. It also has been showing lately in here. We've had an awful lot of days where 80% of the volume has been trading in stocks going up. So 80% of the volume on a given day is in stocks going up. That is a super strong indication of future price action going up. That's huge pent-up demand, explosive action into stocks. That normally does not fizzle so easily. On the flip side, so the market's foundation is strong. Leadership is strong. We've got semis doing well. Banks and financials left for dead. They're coming on strong. The consumer discretionary is really strong. And the transports aren't bad. My 4 key sectors are rocking and rolling. Good sign. Now, on the flip side, there we go. Market sentiment is not so fine. And in the blog, I've written that it looks like, January of 2018, where stocks went straight up, and that is right over here, right before a 13% decline, as well as late 2019 over here, right before the bull market peaked and COVID came. You've got, positivity and bullishness that became giddy. And now we're in that greedy, euphoric stage. That's not a healthy setup. So you've got sentiment is very concerning, and the insiders and corporations are selling stock. All worrisome things, but the foundation of the market is super strong. So you've got a dichotomy, as I wrote about a couple of weeks ago, pulling in opposite directions. Usually, the market's foundation wins out over the intermediate term. The short term, Johnny-come-latelys are punished. So stocks sometimes see a quick elevator shaft decline, then a rally. This is certainly an unusual time. We've got a change in power in the White House. We've got small caps and value leading. I don't think this will be as cut and dried as it's been in the past. What you can see on this chart is what are we looking at? The American Association of Individual Investors, which are skewed towards baby boomers. But you'll see on the far right, the people who are positive in this green histogram, last couple of weeks, they've stepped up, and people who are negative has shrunk. And you'll see the bulls divided by bears down in purple. You're getting to that worrisome, troublesome area, like I just mentioned. So that's one of a number of sentiment gauges that's flashing warning signs. Again, keep it in mind. I think the easiest money, a 10% November is pretty good. I think the easiest money has been made. But I'm not buying bottled water and canned goods and spam right now. I don't really like spam. But I'm certainly not buying more bottled water than I already have, and I'm not buying any more canned goods. Although I still have half a case of honey brown sugar bacon baked beans from what I bought. I think I bought it last February for the pandemic, and I just never ate it. I don't know why I never ate it, but I didn't. So let's see. Let's stop sharing my screen, and we will move on to my last topic, which is seasonality. 1 second. There we go. Back to my ugly face. So seasonality. We're in that bullish time of November through April, the most bullish time of year. Blah, 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 blah. You've all heard sell in May and go away. It doesn't work in the modern era. November and December are very bullish months seasonally. We saw November had a monster rally. So you can't be shocked if December is not an enormously positive month. Would I be shocked if it was negative? No. Could it go down 1%? Sure. Can go down 2%. The odds don't favor it, but after November, it's certainly possible. And then I think you'd have another big rally in January and February. Could we go up in December a little bit? Yes. I don't have strong conviction, as you can tell, about what the whole month's going to look like, other than seasonally, we normally see a peak, a short-term peak this very week. Over the long term, this week, we normally see a peak in stocks. They either go sideways or the rally moderates first. And then stocks either go sideways or they gently pull back for a week to 2 weeks. They put in a low in the middle of December, and then they have that beautiful Santa Claus rally that you'll begin to hear about ad nauseum in another week or two. And I write extensively about it like I did with the election. My take on the Santa Claus rally is based purely on data. It's not based on my feelings or what I see or what all those idiotic pundits are saying on TV that base nothing on data, but on their feelings. And feelings don't make money, and you can't run money based on feelings. So I will publish data. You can agree, you can disagree. I just publish what the data says, period. But seasonally, we're in a strong time of year. Usually November, December, January, 3 seasonally strong months. And any weakness we see in the coming days and maybe a couple of weeks should be used as a buying opportunity. I would not put all my eggs in any basket. Small caps will typically outperform large caps during points in in December into January. But it doesn't mean we dump all our money into small cap. We just sold them. I forget. Last couple, I can't remember, or so I'd certainly share the date. Last couple of days, we moved money out of small caps. And it's not a long-term move. It's a short-term, what I'd say is a tactical or quick move. But I imagine we will own small caps again before the end of the year. It's also It's also a time of year where tax loss harvesting is pretty important. That's one thing it's one of the value adds we do for clients. If I find losses in portfolios, we will sell those out at a loss, let you recognize that loss and substitute it for something that may be similar. So if I owned United Airlines and I liked American, I'd sell United, take the loss, buy American Airlines. If I owned which we just did, we had a cannabis marijuana pot ETF. We've owned it. I think I bought it a year ago, but I'm not 100% sure. it is in the red. It's been a loser. So we sold that. We'll take the loss, and then I'll find something else in that space if I want to own that. So it's a good time of year to begin to pair up gains and losses. Certainly, if you can take your losses, might as well take them. I'm sure energy stocks will see some tax loss selling. But as I said in the media on Yahoo, I've written about it. Next 10 years, I will bet an awful lot that old-fashioned, boring, stodgy, somewhat hated energy beats the socially responsible investing sector. That's not a feeling. That's just based on data. Energy has stunk for so long, and it got to a point where the next 10 years, it should be one of the winners in the stock market. So with that, I know I've gone over. I really appreciate you watching. I hope you continue to stay safe. Obviously, please stay healthy. If you like what you listened to and saw, except for my face, then please give me a thumbs up. And I promise I'll be back shortly with another video. So thanks again. Talk to you soon.